What exactly is worrying you about these markets right now? It seems as though it's the only thing that's been happening. Markets keep going higher and higher and higher over the course of the last almost year now.
Well, thanks for having me, Dom. And, I agree. We have seen tremendous performance out of the markets. And when you think about sort of what is the psychology that's pushing this, generally it's the idea that this was never going to be a permanent situation, that the pandemic would be a short term or possibly medium term event, and you would eventually sort of get to the other side and have a recovery. That recovery is not only priced in, Dom, but actually we've seen continued we've seen continued multiple expansion, even considering where we were in earnings at the beginning of the year. And even though we've had spectacular earnings, we still haven't caught up. And the economic recovery doesn't quite catch us up either. And I think that the markets have just are well beyond their skis at this point, priced into perfection. So far, the vaccine recovery hasn't gone, the vaccine rollout hasn't gone well. And there's still a lot of questions sort of left hanging over the market, but the market doesn't seem to want to budge. It just seems to want to continue to price in positive outcomes.
I mean, the positive outcomes have been coming for the stock market for a while. What's got me interested more today is the bond market. We just showed that the 30-year long Treasury bond is right at about 2% yields right now. For context, that's kind of what it was pre-pandemic, which means that that whole idea of asset reflation, of growth and inflation coming back is all now pricing into the bond market as well. Doesn't that suggest that there's more runway if the bond market is just now catching up to the reflation that stocks have had for quite some time?
Well, yes, although it could also be that the bond market is also pricing in some inflation. We've seen some tremendous stimulus, and we're expecting even more stimulus. And that continued, surge in debt could come with inflation. If you look, for example, at TIPS, Dom, TIPS have actually been a spectacular performer over this past year. They got incredibly cheap during the pandemic, during the March lows of the pandemic. And now I would argue that they're quite expensive. But you have to ask the question, are we really going to see inflation trending above 2%? That's where break-even yields are. And if that were the case, we'd see the Fed backing off sooner rather than later. And that I'm not sure we're going to see.
Should we fear 2% inflation? It feels as though 2% should be kind of normal, right? It's not like it's hyperinflationary at all right now. There are no signs it's going to get that way. What about the case being made by some investors that, 2% inflation is kind of where we should be, not even pricing in hypergrowth?
Well, see, that's the problem, is that 2% inflation is where we should be, but we haven't been there in a very long time. We've seen a tremendous amount of debt growth, but that excess money, that money supply that we've been printing hasn't actually gone into wages and goods and services pricing. It's been going into the asset markets. And in fact, asset prices are tremendously inflated from a decade of continued stimulus, not just this latest stimulus. And that's really kind of the thing that kind of, I think, in the longer term has me questioning whether or not we see value here. And Dom, there's so much evidence in terms of excess exuberance and excess money. That money is going into things like blank check companies. You mentioned SPACs. You mentioned cryptocurrencies. These are literally instruments that are worth whatever someone is willing to pay you. There is no intrinsic value. IPOs are just through the roof. There is so much demand because there is so much excess money and so little value.
Shepard Smith here. Thanks for watching CNBC on YouTube.